Well, welcome, welcome, welcome. Thank you all for coming here today on this beautiful afternoon. My name is Adrian Coxon, and I'm the Chief Marketing Officer at EXANTE. I'd like to introduce the concepts we have here. We call this our Horizon panel, and the Horizon Forum we've created to bring together international economists, global experts to discuss the economic themes of the day. And it's been quite an interesting week for us to be picking up this conversation this week, and also to be in this historic building, the EXANTE Palace, where there's a rich history here of Thursday afternoon gatherings where the king used to bring together the great and good of his day into this room to discuss similar topics. Before I pass the mic over, I'd just like to say two things. One is we are following Chatham House rules here, so there are journalists in the room. We want a frank and open discussion. You can use the information as you wish, but if you want to quote any of our panelists, please come to us afterwards and we'll organize a proper interview with you. And secondly, could you please make sure your phones are on silent? We'll be doing a quiz later on, but please make sure your phone's on silent so you don't disturb the event. And now, with no further ado, I'd like to pass on to Szymon Turecki, who's our head of sales in the Poland office, to say a few words in Polish.
Thank you very much, Adrian, and welcome everyone. I see a lot of Polish guests, so I'll switch to Polish for a moment. Bardzo mi miło Państwa gościć tutaj w Pałacu Królewskim na Wodzie. Zaszczytne miejsce, w którym niegdyś najwybitniejsi intelektualiści rozmawiali o kulturze i przyszłości Polski. W EXANTE również myślimy o przyszłości, szczególnie jeśli chodzi o technologię i naszą platformę, która ma pomagać naszym klientom w rozwoju ich biznesu. Jestem niezmiernie dumny, że możemy po uzyskaniu licencji KNF-u pochwalić się naszym oddziałem w Warszawie. Serdecznie tam Państwa zapraszamy, Emilii Plater 53. Nasz zespół profesjonalistów z przyjemnością przybliży Państwu nasz biznes, naszą firmę i naszą platformę, na której znajdziecie milion instrumentów finansowych na ponad 50 globalnych rynkach. Jesteśmy tu dzisiaj dla Państwa. Więc jeśli będziecie mieli jakieś pytania, to zadawajcie. Umawiajcie się na spotkania kuluarowe. Z przyjemnością postaramy się sprostać waszym pytaniom. A teraz już nie przedłużając, zapraszam na główną część eventu. Renée, let's dive to the event.
Okay, great. Thank you, Adrian and Szymon. Welcome to our EXANTE Horizon event. I'm very delighted that you can join us today here in this amazingly beautiful venue, a historic venue. I'm Dr. Renée Friedman. I'm, as you can see, head of research, global head of research at EXANTE. And today we are joined by a panel of very distinguished experts. So starting down from the very end, we have Dr. Arnab, who is the Global Economic Counselor at Invesco. Professor Grzegorz Kołodko, of course, former finance minister and former deputy prime minister of Poland. Dr. Jarosław Jamka, who's a portfolio manager and vice president of NDM here in Poland. And Andrew Kenningham, sorry, my apologies, chief European economist at Capital Economics. Before we begin, we'd like to run a poll, as was mentioned. So we can get up the Slido information, please. The slide, please. Yes. If you could please take your phones and join that on Slido, we'd be very grateful because we'd like to ask you a couple of questions, if possible. Okay, give you a moment to get yourselves in there. Okay. Right. Let's move on to those questions. Hopefully, I'll give you another minute to log in. Takes a little bit, perhaps. We're okay? Okay, give you another minute. Okay, I think everyone should be logged in by now. So in terms of the questions that we have, I'll say it in English, that's obviously translated in Polish. What are you mostly thinking about for Poland this year in 2025? You can see your choices up on the board, up on the screen there. I'll read it in English for the non-Polish on the panel. A, I'm mostly optimistic because I think the Polish economy will continue to grow and will benefit from greater investment and European unity. B, I'm most worried about the impact a forced peace in Ukraine may have on Poland's security and future growth. C, I'm worried that the government will collapse with the election and Poland will become more isolated from Europe and suffer for that.
Yes.
And finally, D, I am confident that Poland will continue to be an effective leader in Europe in its current position as EU Council President, and that it will continue to cut red tape, increase competitiveness, and become ever more resilient. So we'll see what the answers are on that. I'll give that a moment. I don't think we can get actually all the responses. We can shrink the size of the screen a bit, or I think the lead on that one actually appears to be everyone's very optimistic. Right at the moment, we have about 46% saying that's very much how you're feeling for Poland, which is great. But let's move to the second question. Oops. Coming through. We'd like to ask is, which sectors globally do you think will outperform in 2025? A, equities and equity ETFs, bonds, commodities, currencies, or cryptocurrencies?
Ooh.
Well, it seems at the moment, still have some voting going on.
Do they not seem optimistic on crypto?
It's moving around a little bit. No, it's coming out quickly. Right. Interesting view on that. So it's coming in close between commodities and equities. No, I think we do have a clear winner on this. So everyone is still extremely positive about equities and equity ETFs. That's the good percentage of the people in the room. Okay, and that's very interesting as we get into today's panel. So before we actually delve into the panel, get to that in just a moment, I just want to give you a quick summary of 2025 so far. We're almost through the end of Q1. What have we seen thus far? Global inflation has continued to decline, although its headline is starting to go back up a little bit. The core remains sticky. Oops. What's my place here? Global growth has been stronger than expected, but we have to question, can US exceptionalism continue? We've seen stock markets hit by Trump tariffs, slowing US growth and a cautious Fed, questions around debt, crypto volatility, for those of you who answer crypto, swings in the dollar in terms of its valuation, and of course, the greatest risks that we will be discussing today, the geopolitical risks. Whether or not Ukraine is on a path towards peace and what that means for Poland and what it means for Europe and the world. Those NATO tensions that have developed. We'll touch on a little bit in the wider world in terms of China, US, and Taiwan tensions, and of course, the issue around energy security. So I'd like to ask the panel to start today's discussion with their views of the world today in very short form, in just a few minutes. Time frame, please, about 5 minutes. So to begin with, I turn to Professor Kołodko. With your decades of economic and political insights on Poland, could you please give us a quick overview of the state of Poland today, where you think it's headed, and how this fits into the wider European story?
Good afternoon. Thank you for the invitation. Appreciate that you haven't described Poland as emerging market, because we have emerged already. And the process of real conversion to Western Europe standard will continue. So from the bird's eye view, Poland is delivering the good news, yet from geopolitical viewpoint, we are in an extremely difficult situation. When I was in the office a long time ago, the political situation was much more favorable than it is today, but there is a silver lining despite all these challenges. Poland will stay the course as far as the real economy is concerned, and we will remain the fastest growing economy in the European Union and among the OECD, to which I have brought Poland almost 30 years ago. And as far as the financial side of the spectrum is concerned, there are problems, and there will be even bigger problems, because from this perspective, we have the biggest deficit, fiscal deficit in Europe. When we are conferring here, the leaders of the European Union in Brussels are committing serious mistake. They accept these hours, these minutes, so-called exit clause, and it will be possible to add 1.5% to the current 3% of GDP, and that will be considered acceptable level of fiscal deficit against the rules which have been established a long time ago. So that will fuel inflation in most of the European countries. Already 8 of these countries are under the Commission of Europe procedure of excessive fiscal deficit, including Poland, and Poland is leading this negative show from my perspective. But on the other hand, as always, there is a good news, because a lion's share of this money, additional money, more in other countries than in Poland, because we are now #1, this time within NATO, 32 members, as far as military expenses, defense expenses relative to GDP are concerned. The question is how much we will follow the wish of President Trump, and how much European Union, especially European countries, will waste money for import of American weapons, and how much will be invested in defense industry in Europe, including in Poland. There is the political debate about that, because the American pressure will be spent more, and buy, similarly like drill, baby, drill. You know, we will hear buy, baby, buy. So the question is how much will be misled by this buy, baby, buy, and how much will invest in our defense industry, which is definitely lagging behind, also from technological viewpoint, but not with all particular aspects. Another silver lining is very important, and that is already linked to the geopolitical situation. I bet there are only assumptions. We are not about nothing, we can be 100% sure, but it is much more likely now than, say, a week or a month or a year ago, that there will be the ceasefire in Ukraine, and at least they will stop to kill each other, and then there will be the great challenge, how to finance, how to manage the rebuilding of Ukraine, and of course it remains what we mean by Ukraine after the ceasefire. We will contribute to the rebuilding of the part of Ukraine which will become Ukraine. The part which is annexed by Russia, it's their headache, and much more destroyed is this part of Ukraine than the one which is under control of Kiev. There will be not very much shift of the line between the Russian army and the Ukrainian army after the ceasefire. And then there will be a great boom, and there will be the great quest for finance to co-finance this rebuilding effort. Some money will come as grant or cheap loans from the European Union, European Bank of Reconstruction and Development, European Investment Bank. I think not that much from the World Bank, where the most influential is the United States. There will be some new financial instruments, the one which I proposed prematurely, European Fund for Reconstruction of Ukraine, when I published my essay in the Financial Times. And that is, of course, with the consequences, implications for the financial market, how to finance it. Most will be financed from raising the debt, hardly much from raising the taxes, because that is what the politicians are afraid much more than any enemy, raising taxation. So it will be going into the fiscal deficit, and then the debt market will mushroom. This is the good news, and this is the bad news, because the bad side of this news is that it's already agreed accepted by the European Union, also the invasion of the Polish government, that some funds which were supposed to be invested in cohesion, in infrastructure investment, in human capital, now will be accepted by the European Commission and will be shifted into so-called defense. So it depends what part of economy we are talking, because from the bird's eye view, GDP maybe will be growing a little bit more faster. But unfortunately, in the longer run, the infrastructure, which is so much important for the business, will slow relatively slower. So for myself, as a peace-loving economist, these shifts are not going into the right direction. But from the financial markets, there will be very many challenges and possibilities to speculate, to make the volatile markets quite good business. If I was from outside Poland, is it New York, London, or whatever other beautiful, interesting place in the world, I would bet for Poland. There won't be the war. They won't be the war. It's just stupidity what the politicians are saying, that we have to get ready for the war, etc. There will be the tensions, that will be the problems, but there will be the peaceful development. I'm talking about Poland. So taking a fast look all over the world, I think Poland is one of the most promising places. And once again, there is a silver lining in this whole process. So I'm happy that we have this EXANTE conference here, because the more capital we come to Poland, the better for us and the better for you, because we are competitive and we will be even more competitive in the foreseeable future and in the long run. Poland is a successful story and it will hold.
Excellent. Okay. Some excellent points there. And now I'd like to turn to you, Andrew. As someone who spends his time focusing on wider European developments, what is your take, essentially, on the state of Europe today, what Professor Kołodko has said, and where do you see the direction moving? Do you see any particular trends emerging?
Sure, thank you, and thank you for the invitation to come and speak here. Very interested to hear Professor Kołodko's outlook on Poland, which I can only share that our company, Capital Economics, also has a very positive view of Poland and has our 5-year forecast for Poland is well ahead of that of all of the other larger European Union countries. I personally spend more of my time looking at Germany, France, Spain, Italy, and the Eurozone as a whole. So I thought maybe in this introductory comments, I'd just comment on just what we were expecting a few weeks ago and how much the news events over the past couple of weeks have changed that. So if you'd asked me here 2 weeks ago, I would have said the outlook for the Eurozone is for continued very sluggish growth. I think that's something we've all become very used to. Europe is wealthy and comfortable, but is not the region which produces the big innovations, and and it's a country with a region with very low productivity growth. It's also been suffering from weakness in Germany, which has been so important in the past. And the German economy has not grown at all for 5 years, and it looks as if that will continue. It looked as if that would continue for quite a while, because essentially we have a structural slump in Germany where it has sort of old world industries which have not yet adapted to sort of digital world and the new geopolitical situation. So our forecasts were very weak growth, and inflation, though, to come down. It's already below 2.5%. There are signs already that core inflation is coming down. So we thought the European Central Bank will be able to reduce interest rates and bond yields will stay very low. Now, there have been two really big events over the last, well, there have been numerous big events over the last few hours, but just to keep it to two big things that have happened in the past few weeks. First is the tariff threat from the US. Now, of course, we've been aware of that for a long time, and in fact, we had included in our macro forecasts an assumption or working assumption that the average US tariff on European exports would be about 10% from the middle of this year. That's still what our working assumption is, but clearly there's a risk that it is higher than that. So that has introduced an additional uncertainty, and I think is a downside risk to our growth forecasts. However, I do think a lot of other forecasters overstate the degree to which tariffs are a threat. Europe, the exports from Europe to the US are only account for less than 2% of the European economy. And even with a tariff of 10, 15%, the dent to those exports would probably be quite small. So we'd taken a view that tariffs are not quite as big a threat as people think. That said, if there's like a 25% tariff, and if there are tariffs on particular sectors which are much higher, then the impacts could be very significant for some sectors. But in general, we thought the outlook for tariffs not such a risk, and I think the European Union would react very calmly to tariffs. They will talk a lot about huge retaliation, but in practice, they'll do relatively little. We calculate at Capital Economics the retaliation ratio, which is what is the value, the effective size of the tariffs that other countries put back on the US relative to the tariffs the US puts on them. We think it will be very low. The second big event is, of course, the shift in defense and fiscal policy, which has really come to the fore this week. And that, I think, is going to have a bigger impact in the short term, particularly in Germany. So the announcement from Friedrich Merz only came, I think, the day before yesterday. So it's only an announcement in principle, and a lot of detail yet to be fleshed out. But it does look as if Germany, in particular, is going to run substantially looser fiscal policy over the next couple of years, or maybe over the next 3 or 4 years. So rather than running a deficit, which we had thought would be flat at 2.5% of GDP, I think they'll increase it to maybe 4%, maybe higher, over this period. That is sure to boost the economy a bit and potentially lift inflationary expectations, which is why we've seen such a big move in markets over the last couple of days. The exact extent of the impact is something we could discuss a bit more, but it's not clear it will be how big it will be. The elasticity of defense spending might be relatively low. Germany's already quite near to full capacity. So there are a few reasons to think that defense spending might juice the economy a bit, but not drastically. So the upshot is we're going to push up our forecast for GDP growth a little. But for the Eurozone, we're still talking about 1%, a little bit higher over the next 2 or 3 years. And even for Germany, I don't think trend growth will be back to the 2% level it was at before the pandemic. So very often, I think these big geopolitical events actually have much smaller economic consequences, and that probably will prove to be the case this time as well. But again, something we can discuss. I'd also be interested to hear about the impact of defense spending on the Polish economy, because that's a relevant comparison.
We'll get to that very shortly. So, Dr. Jamka, Jarosław, although you are based in Poland, you do tend to invest more in sectors outside of Poland. How are you feeling about what is happening in Europe, and what are your quick thoughts on the state of US and European markets, following on from everything that we've seen this week and over the past couple of weeks?
Yes, I've got a couple of slides. Maybe
Yeah, if we can get those slides up.
Can you show? Yeah, this. Good afternoon, and thank you for the invitation. As Andrew said, there's a lot of changes on the market. Yeah, you can. It's basically hours, not only weeks, but hours. Yeah, you can, and I was struggling to make sense of the markets. Yeah, how to start, and then I realized that that the Scott Bessent plan for going forward is a quite basic economic targets for the US. Yeah, and it was announced, or Scott Bessent was talking about those plans last summer, and then, of course, we got a plan with the free freeze. So it's he was talking about 3% of budget deficit, so going down to 3% at the end of the Trump's term. Yeah, so then 3% growth and 3%, maybe not 3%, but 3 million of new barrels of oil daily, so increasing the supply of oil. So after all, decreasing the price. And when it was announced, I saw such articles that it's not going to be free, but rather 260. So not 3% growth, but 2% growth. Budget deficit not 3, but 6, and the barrels not 3 million barrels per day, but 0. And when you look at how they are doing, and how effective are they, I'm impressed that we are going in this direction. Yeah, and of course we can also have a talk about what is the Trump's plan, economic plans, and it will be very difficult to really show the economic targets because they are changing every second day. And here, if you are going for the 3 million barrels extra supply, of course, U.S. cannot do it on a, let's say, in a relatively quick way or quick period of time, but OPEC has something like even more than 4 million barrels of spare capacity. So it's just Trump just asked the OPEC to increase the production, and they are starting in April. Yeah, so they are withdrawing the previous production cuts, and there might be more to come. And it's very interesting because this particular, let's say, extra supply of oil could kill the inflation and also put a lot of pressure on Iran and Russia, because the lower oil prices means lower budget revenues for those countries. Yeah, so it's easier to negotiate anything. Yeah, and so this is the basics for the economic targets. And what you can see here, there are no tariffs here. There's no Ukraine here, the wars, the Gaza, Trump-Gaza, or Trump, and any other topics which are, we are looking at every 2 hours. They are changing the world and changing the markets. So if we can get to those targets, and they are quite effective right now, in my opinion, then we can also be moving to the next phase of the market cycle. I mean, it's more like we can move to the interest rate cuts. Yeah, we got the next slide. What is the main reason why we are not talking about interest rate cuts is of course inflation. But if there is if we can kill inflation by lower oil price, plus we can also if the market or economies are afraid of the growth scare also can decrease the inflation scare. Yeah, so there are plenty of room to cut interest rates, and then we can move to this next phase of the market cycle. I mean, Goldilocks or soft landing narrative. Yeah, it's really rare when you look at from the historic perspective to jump from the growth or from the bull market to the bear market. Yeah, in the between, usually markets first focus on the soft landing, interest rate cuts, which are good for the economy, and so on. So I think that could be the next phase of the market. Of course, not tomorrow, not let's say in a week time, but from the market, from the full market cycle, that could be the next phase, and it will be good for equities, for example. Yeah. And last slide, I want to show you the performance of the equities, selected equity indexes. Just from the start, from the 5th November. So this is the start. This is the moment Trump won the elections. And what is the main difference is the U.S. equities, S&P 500, is flat. Yeah. And what was interesting, I think this is the first strike price of the Trump's put, because when we get here to this level of U.S. equities, the Trump was starting talking about decreasing the tariffs for Canada, decreasing tariffs for Mexico, and we had this quite a strong rebound. Yeah, so I think today, when you look at the different analysis and sell side recommendations. Everybody is running and talking about how things are good for Europe and the next arguments for the outperformance of Europe. I think it's the economists are quite, let's say, interconnected, US and the European economy. Yeah? So I would expect, as a next move, I would expect the rebound and outperformance of US equities and some moderating when it comes to European equities. So that's
Great.
more or less my opinion.
Well, I'm sure we'll have plenty to discuss in terms of what will be happening in equities markets. But first, finally, I'd like to get to Arnab, because your remit is more global. So how exactly do you see what's happening in Poland with the upcoming elections, more broadly across Europe and the UK, interacting with what's happening in North America, both not just the US, but obviously Canada and Mexico as part of the ongoing tariff debacle happening there, and potentially even Southeast Asia events, but over the medium-term view?
Okay. Thanks very much, Renée, for inviting me, EXANTE, as well. It's great to be here back in Poland. I used to come here in the 90s quite a lot, but it's been a while since I've been here the last time. I think this is the third EXANTE Horizon panel that I've done, so I really enjoy these discussions. Like Andrew and Professor Kołodko, and maybe Jarosław as well, I'm an economist by training, but I think, really we need to de-emphasize economics and emphasize politics and geopolitics, obviously. And I think we should recognize that central bankers are no longer the titans that they once were, right? Andrew said geopolitics doesn't really make much difference. With respect, I disagree completely. I think it's difficult to connect the dots between the geopolitics and the economy and the markets in the short term. But obviously, we're living in a historic turning point of various kinds. And so I'm going to try to put all these questions in a kind of US context and try to make sense of what President Trump is trying to do. I guess it's worth saying I'm of Indian origin. I grew up in the US, but I live in the UK. So I try to take a global perspective on all these things, Asian, European, and American. And I think if you step back and look at the world the way I think this group of Americans does it, I may now say things that sound pro-Trumpian. I'm not pro-Trumpian, but I think I can understand where they're coming from. I think if you look at it from their point of view, they see a world in which China is ascending so rapidly that if it came to a conflict, the United States would lose. Right? China is a larger manufacturing nation now than the next 10 largest manufacturing countries in the world combined. So the defense industrial base of the US, which accounts for the Europe that we have here, as a result of the end of the Cold War and the Second World War and the First World War, is actually at risk from the point of view of this group of Americans in North America itself. And I think this explains the kind of craziness about Greenland, about annexing Greenland and making Canada the 51st state. There's this kind of thing, should you take Trump seriously or literally? I think maybe it's worth taking him literally about Greenland and seriously about Canada. I think if you look at the map of the world and think of it in geographic terms and think of it in geoeconomic terms, where resources are located and where the sea lanes go, I think what Trump and company see when they look at the world is a China and Russia that are integrating, the world's largest manufacturing superpower and arguably the world's largest resources superpower, becoming more allied than they've been in some time, since before the Sino-Soviet split in 1956, and posing a major threat to the US from the Pacific and from the Arctic. Right? Of course, it's not there. It's a love-hate relationship between China and Russia, but that's the danger that they see. And hence the idea of taking over Greenland and, I don't know, in some sense, not annexing, but incorporating Canada into much more deeply into a US sphere of influence. Now, when it comes out with these things, people say, oh, you can't just buy countries and take over people and buy people. But actually, that is a large part of world history, and that is a big part of American history. Alaska was purchased from the Russian Empire, Louisiana purchased from the French Empire, and the westward expansion, so-called manifest destiny, it was kind of a given that white American settlers, European settler colonies, would expand across the US. That's what manifest destiny is. And the Monroe Doctrine from President James Monroe was any foreign interference by European powers in the Americas would be considered a hostile act by the United States. So I think, what President Trump is telling us is Ukraine, Gaza, the threat over Taiwan tells us that we're back in that kind of a world. Forget these niceties of the post-World War II settlement where people have self-determination, sovereignty, and settled borders. This is the hard power world that we now live in. So we better wake up and smell the coffee, right? This is I'm not sure I agree with this, but I think this is how to interpret what's going on in Washington. Then I think you have to kind of throw in the question of how do you deal with this problem of China rising so rapidly and perhaps turning Russia into a vassal through this so-called no-limits partnership. Well, I think if you just look at the map of Asia, I think what you see is a strategic cordon around China that consists of the so-called first island chain, Taiwan, Japan, Philippines, maybe parts of Southeast Asia, although the US doesn't have as much influence over them as it used to, potentially India. If you add Russia to that, right, if you can split Russia and China, you can and incorporate Russia somehow into the West or into the US ambit to some degree, you can encircle and contain China. Right? I think that's kind of the objective that is going on here. And if you think about it that way, the central theater of the world competition between great powers and of the world economy, it's already obvious from the numbers, is no longer Europe, it's Asia. Right? So for a European, I'm part European, this is very uncomfortable because we're no longer the focus, and that's why we're being thrown under the bus. That's what's happening, right? With Ukraine and with this assertion even, that the US is no longer prioritizing European security, right? Quote unquote was words of Marco Rubio, who's a very anti-Russia person, actually the Secretary of State, right? So what does that mean for Europe? What does it mean for the world economy and the markets? I think it means Europe has to wake up and smell the coffee. I think what we've been discussing is that it is doing that. I think it needs to wake up further and smell some more coffee. It's not simply enough to increase spending, or defense spending in particular. There's plenty of spending in Europe, including defense spending, right? Outspends Russia dramatically. The quality of that spending has to be improved dramatically. It has to be integrated. The procurement has to be integrated. It has to be interoperable, like under the NATO system. And I would say the decision-making has to be interoperable. What Europe needs to do, in my opinion, is become a fiscal and political union and really be able to stand shoulder to shoulder and defy the US or Russia or China. Is it going to happen? I think the answer is we'll move in that direction, but we won't get there, right? So it'll be somewhat better than it is now. It'll be somewhat less dependent on the US than it is now, but not fully independent. And I think the Americans fully understand this, and they're putting a lot of pressure in different ways on allies rather than on adversaries to get with the program. Right? I think that's what's going on. So there's a long history, actually, if you care to read about it or look into it, of American presidents, much more subtly in the rhetoric, but of American presidents going back to Truman, pressuring allies with economic threats, really threatening to pull the rug out from under them. And every time it's worked. Maybe this time it won't work so well because the power balances in the world have changed. And of course, the interests now are different, right? Because of this Russia versus China consideration, Europe versus the US. So we'll see exactly how that goes. But I think what it means is that diversification is much more important than it used to be. Right? Now, it may seem silly to say diversification is the biggest obvious free lunch in economics and in finance, but what we've been doing for the last 10 or 15 years is concentrating, not diversifying, right? Everybody has been putting all their money in the US, in long duration, in technology, in growth, primarily in the US, which has this unique mix of long duration equities, much less cyclical in the weightings in the indexes than other parts of the world. But I think, obviously, that is now starting to change. I think what we're talking about is a world that is much more volatile, much more prone to supply shocks, much more prone to market volatility and cyclicality, and of course, greater defense spending. That's the most obvious thing. So I think that's actually a pretty good world for diversifying away from the US financially and bringing some money back home to Europe. But I think we should also recognize that Europe is not going to deliver everything that I suggest is all of a sudden being priced into the market very easily. State spending, France is 55% of GDP. UK, where I live, it used to be 40% of GDP. It's going up to 45. Germany, it's close to 50. Everybody's talking about a couple of percentage points more of GDP in defense spending, saying Germany has the fiscal space because the deficit is low and the debt is low. But the footprint of the state is huge. It's bigger than in the Soviet Union, the footprint of the state itself, right? It's not very productive spending. What Europe needs to do, in my opinion, to really deliver outperformance in the long run is to increase productivity. And I don't know of a state in history, other than maybe China, which was the one actor in the economy that delivered a big increase in productivity. That certainly hasn't happened in Europe. So I would say, short term, Europe is going to do reasonably well. Interest rates are not going to fall maybe as much as people had been hoping or has been priced in because of this fiscal boost. But the real question is about how we get a market economy to be more active, more dynamic, more technologically driven, as Andrew was saying, in Europe, in order to be able to deliver all this protection, military protection now, maybe instead of social protection than we have at the moment. Stop there.
Great. Just to start off on the questions then, I want to pick up on that point that you made about the concentration in equities. I know a lot of our audience in the room are, of course, invested within the equity sector. That's the area that we saw that they think is going to grow or outperform this year. So with equities trading at some historical highs and returns have been concentrated in a handful of US tech mega caps, we have the Magnificent Seven in particular, 5 of those are tech companies. Do you think that markets may begin to pull back as tariff bites and this geopolitical discordance is coming to the fore? So I'm going to throw that out first to Jarosław, please, because I know you are looking at this on a daily basis.
Of course, when we are looking at the tariff threats and market reactions, it's happening every second hour. But I do believe that the Trump administration will care about the economic growth and also the stock market. So it's a rather negotiation technique that putting pressure on neighbors, on Canada, China, Europe, and so on. But of course, the other side is sensing that this is the pressure. So the pressure to be successful must be even stronger. So I believe that there will be some, let's say, withdrawal of tariffs or making a deal. And when I go back to the Scott Bessent plan, there are no tariffs there. Yeah, so it's they should deliver on the growth of GDP growth, on the also you can say on the inflation, because increasing the oil supply means lower inflation, and then of course there's very little talk about the Fed. Yeah. And there's quite space there to start talking about more seriously about the cutting rates. Of course, if the inflation will be a little bit less acute like it is today.
Okay. Does anyone else want to answer the point in terms of where we see equities essentially, going for the rest of this year? You've mentioned diversification, the need, that concentration risk developing, but with interest rates, as we've seen, are increasingly diverging. Although we have that inflation story as well. Inflation potentially may come down if we do see that oil price continue to drop. So what sectors should people be looking at beyond the defense stocks that we know are all, zooming right ahead? Are there any particular sectors that any of you would particularly recommend?
Maybe can I just say something about tariffs?
Sure.
And then we can come back. So I think Jarosław, you're right that we won't get the full spate of tariffs as they're being put forward. But we are having tariffs going up generally, right? And that is a trend that has been taking place since the first Trump administration, right? So, I think I would just link this back to this question of the US having become a relatively modest industrial power in the world compared to China. So I think we should take Trump seriously and literally on this desire to reshore. I think a big long-term question about the performance of equities and corporations generally, economic growth generally, is how do you get an economy with higher tariffs, whether it's the US or countries that retaliate or higher non-tariff barriers, to be productive and efficient, right? We have low tariffs in the Eurozone and the European Union right now, but we have very high non-tariff barriers. We have a lot of protection here that is not so easily visible. The regulatory superpower that is the European Union provides that protection through all kinds of non-tariff barriers, which are, I would argue, much higher than in the US. So I think the answer is you deregulate, right? And you force market incentives into the domestic economy as you take away market incentives for competition from the rest of the world. Most countries have a very poor history of doing these two things together, right? That's what you read about in, when you study economic history, that protectionism never works. What nobody ever really seems to say is that the most protectionist country for most of the history, modern history, is the United States, and it's also been the most efficient economy for most of modern history. And I think that's why, right, is because whenever they put up barriers against the rest of the world, starting at the beginning of the Republic, they tore down domestic barriers to competition, trade, and efficiency. And that's, I think, an important part of the question here about how much are they able to deregulate, how much are they able to, kind of with DOGE, cut this federal government, which is actually quite small compared to the governments in Europe. If they're able to do those things, deregulate either de jure, through legislation, or deregulate de facto by putting in people that don't really want to enforce regulation in the regulatory agencies, which is what they're doing to a significant extent so far, I think they will succeed, and the US will perform, again, quite well. If Europe is going to perform in the longer term, before we get to sectors, I think if Europe is going to perform in the longer term, this idea of deregulation, which some European leaders have started to talk about, needs to happen here as well. Right? And I think that's all part of reducing all this protection that we have against these rabid, parasitic capitalists, right? It's, I think there is some rabidity and some, terrible stuff that the capitalists do. But just look at how these capitalists have transformed the world, right? I mean, Bezos, he's transformed the way, at least in much of the West and parts of Asia, how we read, how we shop, I would say how we live, right? And the same thing about, Zuckerberg or Gates or, the most creepy American gazillionaire of them all, Elon Musk, right? I mean, it's transformational stuff. And I suspect that the reason why Europe doesn't have tech giants is because it doesn't want people to get rich. It doesn't really want growth, right? And that, of course, is got to be part of the reason why European equities have not performed well. So what I'm hoping is that what we will see is, together with this defense push, is a lot of deregulation, a lot of reintroduction of market incentives into the European economy, a lot more competition, a lot more dynamism that will offset the drag that comes from a large state, and that will offset the drag that comes from weak, poor, actually quite poor demographics, right? And if that happens, I would suggest it will not be about sectors, but about geographies over the longer run. I'm not going to hold my breath. So now, because I'm not even sure I'll believe it when I see it, right? But maybe it'll happen. Now, as to sectors, I think technology is going to remain very important. It's going to be the crux, not just military hardware spending, But technology, drones are obviously one of the things that Ukraine shows us, drones much more important than heavy artillery, maybe in many respects, although trench warfare or war of attrition also matters. I think cybersecurity is becoming obviously increasingly important. And I think, the kind of the leading edge sectors, pharma, medical, biohealth, all these sorts of things will become increasingly important compared to old economy sectors. I think we're living in an industrial revolution. And here, too, Europe needs to wake up and smell the coffee.
Again, it's fourth industrial revolution. Would anyone else like to comment on where they think the either equity sectors, the best, I don't want to say stock sectors will be for 2025? And if not, I'd like to then move on to quickly, because obviously with one of the factors that affects investment within equities is what's happening in the bond market, the cost of capital. So we've seen some very interesting things happening in bond markets over the past 24 hours alone. What do we see happening moving forward? And we had the rate cut today by the ECB. The ECB cut rates another 25 basis points. So what do we see happening with European bonds versus US bonds and that issue around debt, which I think everyone on the panel has mentioned. So I'm going to throw that out there. I don't know who would like to respond to that, of what you see happening with the bond market moving forward in 2025. Somebody would like to respond?
Maybe I'll go first on that. I mean, I think there has been a very big shift in the bond market, and the sort of rally in long yields and long bonds is, in Europe, I think, is clearly over now. And we'll see bond yields trading maybe around their current levels rather than coming down. We had thought they'd come down to 2% by the end of this year. That now looks highly unlikely. But I think there are other things of interest within Europe. The increase in the yields in Germany, I do not think represents any concerns about credit risk. The debt ratio is very low, and even if they were to add 10-15% to the debt to GDP ratio, I think it'd still be perceived as super safe. So I don't think that's the driver. And the other thing to consider is what's happening to the other bond yields in other European countries. So we've seen some widening of spreads in France last year. Italy continues to be a concern for the Eurozone. So I think those spreads will remain relatively high, and I would think that the outlook for France and Italy in particular is of concern still, particularly as if they begin to step up their own defense spending, and if the EU begins to loosen its fiscal rules. So I would say we used to think of Europe as being a periphery in the south and the core in the north, including Germany and France. I would now say the core is really just Germany and some of the smaller neighboring states, Netherlands, Austria maybe, and the more risky ones are really France and Italy I'd put in a riskier category. Spain and Portugal, in fact, look much better in terms of their debt dynamics, and I think they'll be under much less pressure to raise defense spending. So the outlook for those countries is quite good in terms of bond markets. I'll probably leave it there.
Would anyone else like to comment on bond markets, where they see, and particularly where you see investors might want to focus in terms of their positioning, given...
So look, I would say, I think, we have been in a funk for a very long time where we had very low inflation and very low central bank interest rates as a result, and a lot of QE, and therefore very low bond yields, very low real yields, if not negative real yields. We had negative nominal yields in Europe for a long time. And we had a very low term premium, right? The additional yield that you would need to extend and buy longer term maturities as opposed to rolling over short-term debt, right? Now, I think that world is largely over because we have come out of the funk that caused it, which was deleveraging, in my opinion, deleveraging after the global financial crisis and the Eurozone crisis, deleveraging in the private sector and fiscal austerity in the public sector. What we've been talking about is a big fiscal boost in Europe. What we have been experiencing in the US since COVID is a wartime level of spending, right? We've had a US economy that is growing way above trend at full employment and running a 7% of GDP budget deficit. It's absolutely unbelievable. Now, I think what we're going to get is a big divergence here where, as Andrew and others have said, and we can see happening around us, we're having a big fiscal boost that is in the pipeline in Europe, and we're having efforts to reduce the fiscal deficit in the US, actually, right? Of course, there's this talk of increasing or renewing the tax cuts in the US, and of course, it's unlikely, it's hard, at least it's hard to see how spending can be cut nearly as much. But the Americans, I think, understand that they don't have a lot of fiscal space, right? They have a debt, a gross debt, if you include the surpluses in the Social Security Trust Fund, of 130% of GDP, and they have a 7% budget deficit. So the general direction of travel somehow is going to have to be a lower fiscal deficit in the US. Right? That's the kind of one of the threes, right? How we're going to get there, I don't know. They don't have a convincing story for me yet, but that's, as you said, Jarosław, that's the direction of travel. Whereas the direction of travel here in Europe now is the opposite. Right? So this divergence that we're seeing that's reflected, that was in your chart of central bank rates, right, that converged to zero or even below zero during the crisis and the aftermath of the crisis and during COVID, that's all spreading apart. So I think interest rate differentials and income yields are going to matter a lot more than they have in a long time. And of course, I agree, that's going to make a big difference in equity markets through the discount rate and through the question of this composition of the cyclicality versus the long-termness, if you like, of the index in the countries that we're looking at. So I think it's going to come down to countries as well.
Professor Kołodko, you wanted to add in on that.
Well, I want to make a comment.
Please.
There is no more fiscal space. The only country where you have, it's a paradox, a fiscal space is Poland. Germany has much bigger public debt relative to GDP than Poland. France is much bigger public debt relative to GDP than Germany. And actually, from this point of view, European Union countries, European Union and Britain, Norway, Switzerland, it is much better, are indeed in dire straits. As for the United States, do not expect that the fiscal situation will improve under Trump to zero. This is just, an illusion. It can only deteriorate due to this ill-advised, based on emotions, not on rationality, economic policy. They will pay very dearly for this lack of responsibility in the medium and longer term. As far as geopolitics is concerned, it is absolutely critical. It is absolutely critical also to the bond market, to the equity markets, to cryptocurrencies, to the oil, etc. I don't buy it that OPEC, and you have to be aware that we have OPEC plus, not only just OPEC, will listen to Mr. Trump, and they will supply or increase the supply of oil to bring down the prices. If they will even start to do, instantly there will be the great pressure from the American oil industry on the White House to turn the course, because there is the breaking point of the oil price, and a lion's share of the oil which is being extracted, especially fraction in the US, will not accept the prices of oil going to down. Inflation in the US will accelerate because of the tariffs. Inflation in the European Union will rebound because of raising fiscal deficit. If we will produce more of the weapons, the household sector will not buy the weapons, but the household sector will get the money and will go to the shops to buy the goods. And again, Trump will be saying in, State of the Union 2026 that Mr. Biden is responsible for growing prices of the eggs. That is the kind of, political economy they are discussing in the American Congress. Situation is damn serious. The winner is India in this second Cold War. As far as the big countries are concerned, the name is India, because they are not involved in this stupid second Cold War. Second winner is China, which absolutely will not give up to the American pleasure whatsoever. Unfortunately, our iPad, very important role in bringing Poland to the European Union. We are the losers. Today, we are here, they are in Brussels. We are committing the strategic mistake. Only a couple of months ago, there was the famous, professional, very technical one, really a master, Draghi report, which pointed to the fact that the European Union is losing competition towards both so-called friends, now I'm not so sure about that is US, and neither friend or enemy, China. According to the Sydney Institute for International Strategic Studies, which is an independent think tank, interestingly enough, it was financed, it was sponsored by US Department of State. They made a comparison, 44 critical technologies for the future of the economic development and competitiveness. 37 times number one is China, 7 times number one is US. European Union, any country of Europe, including the UK, is hardly, even on the 3rd place. And Draghi said, you have to raise 800 billion euro, even by a debt instrument, and to shift it into investment in R&D. And today they are meeting in Brussels, and what they do? They are deciding to raise 800 billion euro and invest it in the wasteful military build-up. Because you see, there is the Russian tank over here. This is just a sheer stupidity. And America is playing the game twice. First, if Europe will raise military expenses, we buy a lot more of wonderful, as Mr. Trump says, American weapons. And secondly, we will not invest in R&D, and the leverage advantage of US will stay the course. But the winner, from the technological viewpoint, is already China, and this Cold War and protectionism and tariffs will not stop long march of China. So political shifts, the tectonical political shifts are indispensable fact, and we have to think about bond market, equity market, whatever, always making certain assumptions. Nothing is sure, but I wish I have just concluded a book on the subject, which is called, you guess, Trump 2.0, a revolution of nonsense. This is the revolution of nonsense what the American administration is doing. And if you are talking about European market or Polish market or a real economy, the question is how to adjust to this avalanche of economic nonsense which is coming and will be coming for some time from the United States. It's very difficult because the classical economic knowledge is sometimes not useful. We have to make different figures to stay the course, but from an investor viewpoint, financial markets, it is exciting time. You can make a great deal of money, and you can lose a great deal of money. Even during this 1 hour session, you could make more on speculating on the exchange rate of dollar against Polish zloty than you will be able to make for 1 month speculating on the Polish bond market because of the volatility, which is due to the fact that some other professionals, they don't want to buy or to sell. There is the old Polish joke, we are in Poland, when the young man is asking, maybe he was an investor, a smart old rabbi, tell me please, at last, how much it makes 2 times 2? And the rabbi says, it depends. Are you selling or buying?
Excellent point. That actually brings me to another question. Since you mentioned currencies, I want to kind of go on to the point of the dollar vis-a-vis European currencies, vis-a-vis the zloty. What do we see for continuing to drive sentiment for the dollar? And where do you see it, how do you see it performing in 2025 versus the other currencies, whether it be the zloty, whether it be the Swiss franc, whether it be the euro this year? I don't know who would like to.
Definitely you can bet much more on euro than on dollar, but one more time, it depends, because what you said, I agree. If there will be a strong effort to make Europe union, because for time being this is European, but definitely it is not the union. And we are at the critical moment of time. Mr. Macron is playing his European but also national game. Germany, we have the old government and we have the new government, and nobody knows who is in charge. In UK, we have left of the center government, which is right of the center of the government, because they moved 0.2% of GDP from foreign assistance, foreign aid for military spending, which is the absolutely right-wing movement, etc. So you can bet on euro in the longer run if compared with the dollar. And that is also the problem which we have in Poland. I'm very much in favor of joining euro, even now. Even under the circumstances. If I was now in the government, I would say we are going to start the procedure of joining European common currency, because it would boost Eurozone, European Union, and in the long run, Polish economy. But because of the domestic Cold War we have in Poland between one party and another party, and we are facing the presidential election soon, it is completely impossible even now to touch the issue. You have to bet. Euro is not in Poland longer than Trump is in the White House and Ursula von der Leyen is in Brussels, you know. It will happen, but not before the end of this decade, or maybe only at the early of the next decade. Unfortunately, because I think that if Poland was in euro, euro would even perform relatively better. It's not only the economic question. If Poland is in euro, euro is over the critical hill. If Poland is not in euro, there will always be the question, what about the future of the euro? Because Poland is much more important and will all due respect than many other countries. Polish GDP is bigger than Estonia, Latvia, Lithuania, Czech Republic, Slovakia, and Hungary all taken together. And politically, which are even more important, because we are between what we used to call West, now the question is what West is, and what we used to call East, and it has also the implications that there is a bigger risk, but definitely there is a bigger chance for good profits, good gains. Do come to Poland if you are not yet in Poland.
Okay, well, given all of that, are there any particular views? I'm going to, since there seems to be, and we can discuss this for ages, what will be happening with the currencies, I want to kind of touch on the points you've made about commodities. Again, we've had, with oil and gas stocks, have had a pretty poor Q1. We've seen the recent movements through OPEC+. We've had that discussion a little bit of whether or not OPEC+ will continue to obey Trump and go ahead with the further cuts of price. And I see very much your point about the US producers saying, hey, we don't want the price too low. And of course, there's the implications of that on Russian stocks moving forward. So putting that aside, the other big commodity, of course, is gold. And gold price has been rising almost non-stop since 2023. It's up, again, another 11% this year so far. It was up almost 24% last year. Is gold unstoppable? Should people kind of be saying, right, I'm worried about, we don't know what's going to be happening with equities markets because we don't know what's happening with deregulation. We don't know how quickly the bond markets will be readjusting, so I just put everything in gold. And if you have any particular views on that.
If you have the gold, go and sell it and invest in the rare earth minerals, which are strangely for US, not in US, but in China, Russia, and Brazil. So if I had a spare $1 billion, I would invest in the rare earth, not in Ukrainian rare earth, which is it's very funny, you know, because Mr. Zelensky is offering Mr. Trump what is the possession of Ukraine, but it is under the military occupation of Russia. And Mr. Putin is proposing to Mr. Trump what is the property of Ukraine, but it is occupied by Russia. This is a very strange way of making a deal, you know, with the influences, impacts on the rare materials. And do remember that one country with the biggest possession of rare earth materials is Brazil, which will not follow the suit of White House under Mr. Trump. And so gold cannot be more and more and more expensive forever. We are the winner. Our governor of the central bank has bought so much gold that we have, you know, now more than 20, I think close to 25% of the foreign reserves, which are remarkably high, about equivalent of $200 billion in gold. So maybe they will start also to sell it soon because it will not last forever.
If I may say, I think this point about central bank buying of gold is very important. I hadn't realized that it was so much in Poland, but you know, the big buyers of gold in the world are all kinds of central banks. China, Russia. Russia buys non-monetary gold, right, because it's a big producer, but it has large gold holdings. And I think this demand for gold from central banks, maybe not the NBP, but from others, will continue because it's nobody's liability, right?
It may or it may not, because if European Union will make another mistake and will try to confiscate foreign reserves of Russia, which are frozen, and that was a correct move. They're supposed to be frozen till there is the ending conclusion of this damn conflict, etc. But there is an effort to confiscate it. If that is going to happen, and the US White House has nothing to say, the money is here in Europe under our management, then there will be the shift from dollar to other currencies and to gold. Who is going to win? Of course, China is, and therefore China is taking advantage of it because some countries, so-called emerging markets, they will move part of their foreign reserves from US dollar and or from euro to China RMB, and the share of RMB in the foreign reserves of the global economy will be growing. And again, if you are talking about commodities, this is geopolitics. 2 days ago, there was the summit on future of Gaza in Cairo, of the Union of Arab countries. They have completely different viewpoint than the United States. Mm-hmm. And somehow it has happened, we know why, that this organization, the Arab Countries Union, has very much is overlapping with OPEC. And definitely this is also a part of the game. OPEC and OPEC Plus, which Brazil has joined last week, will not follow the dictum or the wish of Mr. Trump at Consortes because it is linked to the conflict in Gaza, which we don't touch here, but it is also a part of the exercise. The things happen the way they do because many things happen at the same time. That is why it makes so fascinating, at least for intellectuals and researchers, and so risky for you. So some of you will be the great winners if you will bet properly, but some at the cost of somebody else, which will misfire.
Would anyone else like to comment on that point about where you're seeing gold for 2025, as well as the currency? If you go to that point that you are expecting the dollar to decline in the longer term, what do you see? And I'll tie that with the point of currency for this year, because that does tie into that point of, as we are looking at geopolitical change, we're looking at a change in the post-war international order coming through. Therefore, where are the short and medium-term risks? I'm not going to go into the long term, we'll all be dead in the long term, but those short and medium-term risks for investors, given what we've discussed thus far. Jarosław, would you like to?
Maybe I will start with a short comment on gold, because when you look at the gold, this is quite a difficult investment or asset, because it's sometimes it can react positively on the deflationary environment or macro deflationary environment. Sometimes it reacts as a protection or hedge against the inflationary environment. Yeah. So it's historically it's a difficult asset to assess why he is reacting this or that way. But there's an exception for this for the last 2 years. Yeah, after the outbreak of war and confiscation of freezing the assets, reserve assets of Russia, there we got a quite strong demand from central banks, and including China, Russia, and others. And I would expect this to continue in the coming, in a short term. Yeah, maybe also looking forward for interest rate cuts. Yeah, the gold is positively correlated with decreasing interest rates. Yeah, so it's also we can have extra boost from this angle. If the things will normalize, then the hedge is less in demand. Yeah, so then we can have some corrections on the gold. And when you look at the currencies in US dollar, I'm in a camp of long-term bull on the dollar. I'm not sure if you remember many years ago, the exchange rate euro dollar was something like above 160, even 164, I guess it was the top. So right now we are about the parity. And of course, in the short term, the dollar reacted, expected Trump's victory and the tariffs war, trade wars, and which at the end of the day, US is less influenced by the tariffs war, so there was a strong dollar. And if you can look at the trading range, which is something like on euro dollar, it's like something like 112 to 1.0, 0.2, yeah. So it's a 10 points, 10 handles trading range, yeah. And recently, of course, we've got quite a change in the sentiment, including what is Europe doing, and fiscal spend and fiscal stimulus and defense spend. And right now we move back to the middle of this range. Yeah, so I can interpret this as a mean reverting event, which moved the euro dollar just to the middle of the range. Yeah, and looking forward, the market will react on the tariffs, on the U.S. actions, and of course European what the euro is going to do. Yeah, but right now we are in the middle of the range, and this was a mean reverting event, and not for the reason which are historically valid. Usually the dollar is weaker when we got a kind of reflation trade, of global reflation trade. So the global economy is accelerating, not only within the euro, but globally, including China, emerging markets, and so on. But right now, it's more about the fiscal spend and the fiscal expansion, which is moving the euro higher and, of course, dollar lower. But right now, we are in the middle of the range, and I would expect more or less we should stay here, and market will react on the current developments.
If I can just say a couple of things, I think one thing to bear in mind here is that part of the reason the dollar has been so strong is this narrative of American exceptionalism to do with the tech sector. And part of it was the expectation of these tariffs, right? I mean, tariffs are going to go up in the US, and they're not going to stop the imports. Then the dollar is going to move to offset some of the impact of those tariffs. So what we had priced in before Trump actually took office was that set of expectations. And then Trump went much more slowly initially on the tariffs than expected. And now the tariffs are coming apparently in a big way with some carve-outs, right? But there are tariffs coming through on various countries, including China. I think it's important to bear in mind that the US has a trade deficit of over $1 trillion a year. Right? And on the other side of that trade deficit are the goods trade surpluses of China, Japan, and the Eurozone mainly, and some commodity countries in oil or oil products. So now, if in the long term, what's going to happen here is that the US is going to become more self-sufficient by onshoring some manufacturing, maybe by incorporating Canada, no tariffs, no deficit with Canada. I'm not entirely serious about that. But anyway, if the US is going to become more self-sufficient and the trade deficit of the US is going to be smaller, the rest of the world is going to have to adjust to that, right? How can it adjust to that? Well, you have a bunch of major economies that are surplus countries. Trading surpluses with each other isn't going to work, right? So what's going to happen is home bias is going to rise. There are going to be less financial flows going around the world. And earlier I was suggesting diversification. That's going to be the pressure from the real side of the economy in this kind of more self-sufficient direction of travel in the world economy. And to the extent that it's possible to diversify against that, I think would be the right thing to do, because there's pressure for home bias, which is going to work against your portfolio, right? Concentrating your risk in this kind of a world. So I think for currencies, that implies that it's going to become about interest rate differentials and productivity differentials. Interest rate differentials in the short term and productivity differentials in the long term. And I think the long term, that's an open question, right? We don't know, for example, if Europe is going to not only boost fiscal spending, even though there's no fiscal space, and if it's really going to deregulate and make itself much more competitive. If it does, the euro should rise over the long run, not just over the short run. I think the short run case is clear. The long run case is open. So I would be tactical on currencies in this kind of question of increasing long-term exposure in different parts of the world, but maybe much more tactical, and maybe use the currency as an active hedge against those underlying asset positions.
Okay.
In the longer run, one more point, the dollar will weaken. Why? Because out of roughly 14 trillion of US dollars or foreign reserves, which we have globally, about 60% is kept in dollar. But we don't trust dollar anymore. The guys over there in Egypt, in Brazil, in Indonesia, you name the country, they don't trust anymore United States, not only because of Trump to zero. Also, under the Biden administration, people learned, everybody, that so-called West, by political decision, can freeze the foreign reserves. Why to keep them in dollars if we can lose the access to the money if they will not like our political regime? And there is plenty of reasons to not like very many regimes in the world here and there. So for that reason, I think that in other capital cities now, the managers are thinking where to put our reserves, if not in dollar. One serious alternative is euro, and this is good news for euro, everything the same, because we have plenty of problems of different sorts. And there is the third player, which already contributes close to 20% of GDP and is number one on purchasing power parity in the world, that is China, and has only 3% share of the foreign reserves. But China, and I think it is coming, you will call my words, China will give up the semi-currency world with the American dollar. For the time being, RMB is fluctuating the same as the dollar, and in this sense, China depends too much on on US, because it depends on the US dollar. So the question is when they will decide to float, maybe to manage floating exchange rate, and then the RMB will be growing the foreign reserves at the cost of American dollar. And so relatively, the winner is euro, the winner is RMB, and US dollar is the loser in the longer run. In the short run, you made a good business if you bought yesterday afternoon dollars, and now you can sell them even for Polish zlotys, and you will have a good
Can I just dissent a little bit against this?
Okay.
Just very briefly. Yeah.
Well, what I'm going to ask, because I'm aware of the time, and I know we have a room full of questions awaiting us. Given what we've discussed thus far, and I know we can go on for hours on this, given that we've seen this changing in post-war international order, that we're seeing the effect on currency, both currency markets, equity markets, everything that we've discussed, mostly flowing from Trump 2.0, and as we look forward to, as the title of this event is, Between the Two Donalds, I'd really like to just finish off, before we get to the questions, a final speed round question, which is asking each of you to have a quick think about this. Could you please say, in about a minute's time, what is the one key thing that's on your horizon for 2025 into 2026, and why? So one key thing you want everyone who's attending here to walk away with. Who would like to start? Is there any?
Of course, the main issue in this year, the following way, is to proclaim the cease war in Ukraine and to start extremely difficult negotiations with Russia. The war will be over at the table, not at the battlefield. The other issue is how to start to reorganize the global order, because it is now a disorder, and it calls for a very big effort. And this geopolitics is now absolutely at the front line of all the economic reasoning. We have to learn how to talk to each other if we disagree, and we disagree in very many issues. Otherwise, the situation will deteriorate. And from this perspective, it is a turning point. If it will go in further to military build-up, it will be the economic disaster, not the war, but an economic disaster. It has to go towards peaceful development, and I think that everybody has to make whatever possible contribution to start to talking to each other instead of shouting, even about country like Lesotho.
Excellent points. Andrew?
From a European perspective, I think the thing to look for is any sign of a bigger shift towards union. I think a number of us have said it would be a very good thing if Europe was to move more decisively towards economic union, and indeed to implement a lot of the suggestions that Mario Draghi made in his report last year, which are widely seen as being sensible. But unfortunately, I'm really not holding my breath that will happen. I think it was a bit of a missed opportunity over defense spending, where I'm more in favor than Professor Kołodko of increasing defense spending to secure the situation against Russia. But I think it should have been done at a joint European level, both for fiscal reasons and because of the benefits of joint procurement and joint coordination, which Arnab, you talked about. So that's what I would like to look for. And I haven't ruled out that will happen. I think Friedrich Merz's arrival as the Chancellor in Germany is very interesting. He's been very decisive and clear and willing to do things he hadn't talked about before. So he may provide some leadership for Europe, which has been sadly lacking for quite a long time.
Great. Jarosław?
When you look at the Trump 1.0, yeah, the equities and the bond market equities were doing quite well. And I'm looking for a kind of repeat. I do believe that the Trump administration care about the growth. And I'll be looking for those signs that they will deliver us on this side, and a little bit helping to kill inflation with the extra oil supply or lower prices, or also the budget deficit cuts and so on is also deflationary. So I'm looking for Trump administration to repeat the performance of equities and bond markets as it was in the 2019. And of course, this is looking a little bit through the current events, which are market, of course, must discount them. But I do believe that the Trump administration care about the growth and will deliver on this as well.
Okay. And Arnab, 1 minute.
Sure. So I think it's all about great power competition now, and I think that'll drive economic outcomes and market performance. And so I think the question here is, how exactly does the US compete with China? How does Europe assert itself to be a great power? Maybe India will become a great power, not just regionally, but more generally. We'll see. I'm not sure, but it's going to try. And how does Russia fit into this changing world order? Obviously very important for Europe. I would say, just if I may very quickly on this point that the dollar's role will decline, the euros will rise, and China, I'm not so sure. If Europe confiscates the assets, it's Europe doing it, as you were saying, not the US doing it. So I think that'll cause the same trust problem, and you have a fragmented bond market. You don't have reserve assets that are easily fungible, large, or as liquid as the US. And China, well, you have capital controls, right? So even if they switch away from the dollar, you have an exchange rate and an interest rate that are not market prices. I don't think that that's a very good recipe for a reserve asset. So I think what we'll see is payments moving away from the dollar. It's already happening. But reserves are becoming less important, right? And they're not being used as much. Reserves may stay stuck in the dollar despite the lack of trust because there isn't an alternative. So for the currency, that still leaves you, I think, with this question of rate differentials and productivity differentials. Very complicated world.
Very complicated indeed. So I'm going to open up the floor now to questions from the audience. We have somebody, I believe, going around with microphones. So if you could please raise your hand. And I will ask the members of the panel who don't speak Polish, and I'll be listening on both of this, if you have your question in Polish or English, we do have the simultaneous translation. And if you have your question directed to a particular person on the panel, please say so. Are there any questions out there? I can't see. Are there any hands raised? I'm sure. Okay. Oops, if you could bring it right over that gentleman over there. One moment, let her get the microphone.
I have a question to Dr. Das. What do you think is going to happen to NASDAQ long term? Is it going to rise?
Yeah, I think, like I was saying before, this is an industrial revolution that's about technology, and I think, the US tech sector will continue to lead together with the Chinese tech sector. It's much harder to invest in the Chinese tech sector. I'd like to see Europe develop a tech sector, but not by the state saying so, but by creating incentives for technology companies to stay and scale up here. But as long as that doesn't happen, most of the tech is going to be in the US, in the Mag 7 and in the NASDAQ.
Right. Any other questions? Somebody else in the back at their hand raised? Yes.
Hello, Artur Wiśniewski, Stockbroker PL. There was a survey in the beginning of the panel,
Yes.
which showed that many people fear of the geopolitical case, and US will probably leave Ukraine, and there will be less US in Europe. We are still ordering our military equipment in the US, so is it a mistake? And how do you assess this geopolitical risk?
Is it? Somebody like to take that?
My viewpoint is clear, but I know that I'm an extreme minority. There is not a Russian threat for Europe. There is no any possibility that Russia will attack NATO. For that reason, military spending of NATO is a strategic mistake. There will be the end of the war, and we have to start to talk with Russia. We don't like them, but we have to talk. If an American administration is this hours talking with Hamas, because there is the problem to be solved. How to get back home the refugees, the people which have been kidnapped, etc. So that is very important, how we move these days, these weeks forward, because there is the peaceful solution, but not everybody is interested in calming down the tensions. The higher the tensions, even without hot war, the more robust the Cold War, the more military drive. You said that you don't agree with me that we Europeans spend more on military. It's not a problem of spending. Europe is spending more on military build-up than Russia. The problem is with management of the spending, coordination of the spending, a structure of the spending, what has been also touched here. Not spending another hundreds of billions of euro because we don't have money on investment in high tech. And for that reason, this Cold War is very much in favor, especially of the United States. China is not wishing anything bad for Europe. China is interested in flourishing European economy because for them it's a very important market. Russia is wishing us the worst. They will not attack us, but they are definitely wishing us a lot. And I think that they are happy that we are stupid enough to raise, the military spending to 3, 4, 5%, because that is what will drive the money for other purposes. So therefore, there are different interests in this Cold War between US, European Union, Russia, China, etc. United States also wants, and they will do everything what is possible, and they will lose again. They would like to make what was successfully done 2 generations ago by Henry Kissinger under the Nixon administration. But Trump is not Nixon, and Mr. Rubio is not Kissinger. There is a difference. That is to split the cooperation between Moscow and Beijing. They are not so stupid to accept this split. They will work together, but does not mean that China will take over Russia. So the question is for everybody, including for Poland, how to take a part in this great political game, the game of the titans, to win as much as possible. I'm not sure that we are doing so much, because in Poland especially we are between one Donald not far away from here and another Donald very far from here, so you bet for the Donald of your choice. But to all these problems, there is the solution. It will be based, if it will be based on rationality, not on sick emotions, as it is the case recently.
Okay. Did anybody else want to respond to that question? Yes, please.
I'm not feeling to be an expert in geopolitics, but recently I started to listen to George Friedman podcast about the Russia and everything. And yesterday evening I was listening to the recent one, and I think it's quite interesting. I recommend you, of course, to listen to him. Yeah, but quite interesting. His conclusion is that Russia lost the war. Why? Because it's at this moment Russia is lost the status of superpower, because they cannot conquer Ukraine even in 3 years. They started with conquering the whole country. They withdrew to the east, and this is quite interesting conclusion, and could be on the positive side. Looking forward for negotiations and so on, and the future geopolitics in Europe. So I recommend you to listen to George Friedman, for example.
Can I just say something very quickly?
Yes, of course.
I think on the specific question of whether Europe should continue to purchase US weapons, I think in the very short term it probably doesn't have much choice, because there's no alternative, like so many things, when it comes to the US. In the longer term, it should probably build its own, because, of course, the Americans can control the use of a lot of those weapons and the use of almost all the technology that's involved. So if Europe wants to have strategic autonomy, some kind of independence from the US, whether or not the Russian threat is real, it clearly feels it needs the need for deterrence. So then it should have its own domestic or internal Eurozone, European Union capacity, right? And of course, Poland has sort of led the way in that compared to much of the rest of Western Europe. So I would say it should do this build up for the deterrence, even if there isn't going to be a war, to reduce the risk of it. That will eventually result in lower risk premiums, which might otherwise be much higher, right? Like many parts of Eastern Europe used to be. And I would say Russia is not winning the war, but that is because the US and Europe have stood behind Ukraine until now. And there's an open question that if the US continues the strategy of pulling away the military support and pulling away the intelligence sharing, whether Ukraine can hold its own, and if it can do that with sufficient European support, I think it's an open question. Of course, it will be able to hold up for a while, but it's not clear how much. So that alone, I think, shows you the need for deterrence and the need for reducing this kind of single point of failure dependence that Europe has on the US, given that the Europe is pivoting away from Europe, right? That's what's happening. So.
Of course, Russia has lost the war already, from whatever perspective, including the economic one, and by all means, the moral one. Second point, the weapons we will produce and we will buy from US and from elsewhere in European Union will never be used. This is an evident waste of money, but it is very profitable for some businesses. The fine art of international politics is to keep a balance of powers at the lowest possible level of military expenses, not as the highest possible. We have to think how to go back down to 2% or even less of GDP of military expenses, not how to raise them to 5%, because action calls for reaction. Yesterday, China said, we will raise military build-up. Of course, they call it also defense by 7.2%. At the same time, they said GDP will grow supposedly by around 5%. So 7.2 is more than 5%. China is responding for the military build-up and tensions elsewhere. So there won't be the war with Russia, and there is no need to arm, now they call it in Brussels, rearm. There is the need to start the negotiation worldwide but also between European and Russia, and we are not ready for yet. The Americans are here, the front runners. How to go down? One more comment. In 1991, after we had the round table in which I did take a part, and we turned the wheel of history, we, the Poles, were now at the front line, and the peaceful front line. Then they turned down the Berlin Wall. It was the end of the Cold War, to which I now refer as the first Cold War. Now we have the second one. Between 1990 and 1996, the global military expenses, called everywhere defense, fell down from 1.6 trillion to 1 trillion in 6 years by 1/3. Why? Because we did have in Moscow Mr. Gorbachev, and we did have in Washington Mr. Reagan. Now we have Mr. Putin and Mr. Trump. It's a disaster, but we have to find a way to reverse the turn and to shift money from military spending to civil purposes. It is feasible, but not under this political leadership which we have.
If I could just say, I mean, I agree with you in principle, but Mr. Reagan did a massive American buildup before the collapse of the Soviet Union, right? And that was part of the story of the Soviet collapse.
Mr. Reagan brought together with Paul Volcker inflation from 12.3% down, but at the cost of very big recession. Mr. Trump will, raise inflation and will bring the relatively high rate of growth. So the only comparison between them is that Mr. Trump is 45 and 47th president of the United States, and Mr. Reagan was 42. Otherwise, Reagan, which, as you may guess from what you've heard or what I have said, and maybe you have read some of my books, I was never a fan of Reaganomics or Thatcherism, but definitely it was much better than Trumponomics.
Okay, we're going to move on to another question.
I agree.
Okay, originally I intended to touch the vital issue of the joint borrowing in the European Union, as it may be the only chance for the European Union to prevail, and obviously a huge game changer for European assets. Yet I have a feeling that you are, or the majority of speakers are rather skeptical on that issue. So I would like to ask about something a little different, more market-wise. We all know that the markets became extremely headline-driven. So one day we have tariffs on, the other tariffs off, and it creates huge swings like we had in euro, plummeting European bonds and so on and so on. Do you fear that such circumstances might prevent longer-term trends from emerging, that they will impact negatively the liquidity of the markets, and investors will be very prone to profit-taking and just selling the rallies or buying the dips?
Excellent.
Maybe I'll just... Shall I respond briefly? I mean, I'm not particularly a markets analyst, but I would say that it does seem to me that these short-term movements will probably, driven by news events, particularly things like the tariffs, which often get withdrawn and so on, are not likely to have a really big impact on the big markets questions, like where is the US equity market going versus the European equity market. That's the sense in which I meant that geopolitics often is not going to be the key determinant of what happens in financial markets or economies. I mean, clearly it does have big impacts, and these long-run questions are very important, but if your job is, do I invest, deciding, what I invest in, then I think you try to look through all of this noise and look at what are the really important determinants of, equity market performance or bond performance. And very briefly on that, I mean, I agree with, I think it was Arnab was suggesting that it's the tech stocks which will continue to be, and technological change will continue to drive profits, and that will continue to be mainly in the US. And despite the tariffs and all the tensions between the US and Europe, there are currently there's not really a likelihood of capital controls. There's not really likely to be much in the way of tariffs on services. The big digital companies from the US are going to continue to make a lot of money from selling into Europe. So I would say a lot of those things remain intact, and I would focus on that stuff unless you want to give yourself a massive headache by trying to predict what mood Trump's going to be in every morning. I don't know if that answers your question, but that's kind of the way I would look at it.
Okay, is there any more questions? We have time for one more question. I'm aware that we're running a little over schedule. Is there anything else coming through? Okay, well, I know that this is a discussion that could go on for hours and hours and hours because, as you can tell, we have some slightly differing opinions. So I would very much like to thank the panel for sharing their thoughts and advice and insights with us. And of course, I'd like to give a big round of applause to the panel if we could. And I'd also like to thank all of my colleagues who helped organize this wonderful event today, today's event, many of whom are here with us today in person. And of course, I'd like to thank all of you for your attention, for joining us today. I hope you've gotten something out of this event. If you have any additional questions, please come and find us. So thank you again, and let's go enjoy some drinks and canapes.
And just the last word. Someone's left a ring in the toilets. So if you recognise that,
Is it a wedding ring?
it's yeah, someone's got divorced, obviously, at our event. So they're not the only disagreement in the room. So if it's a ring, if it's your ring, it was left in the toilet. And yeah, and we've got drinks and
Drinks and canapes in the other room.
In the other room. And yeah, I'll reiterate what Renée said. Thank you for organising this, everyone in my team and everyone at EXANTE Poland for getting involved. And thank you all for coming today.